Hello, guys. Welcome to Just Business Talk DXP. Our today's topic is how to do a due diligence when you decide to buy a business in Dubai. So, this is a very important topic. This is the most important step when you are buying a business due diligence. You cannot go wrong in this step. In due diligence, there are a number of things you need to make sure that you check on that business. Uh, it is there are two part of due diligence, and then there are subtasks on every part. So one is legal due diligence, and then the financial due diligence. In legal due diligence, you need to check on that business that business is having no problem with the authorities. It has a valid operating license, and you need to check the Ministry of Labor, which is where they hire the workers. They pay their salaries on time. The system called wages protection system. That you need to check their visas um, uh, are valid. Immigration, everything is okay with immigration. Then you need to check their Ithal Credit Bureau, which is a credit rating agency, to make sure that they have no bounce check, no bank liabilities, and so on, are what has been disclosed during the negotiation or when you bought that business or agreed to buy that business. And then also, it is very important that on that process you check there if the business is VAT register, their FTA accounts, Federal Tax Authority, to make sure that their VAT returns are on time, there are no penalties, and so on, or there are no hidden surprises, which you're going to find out later on. And also, as part of the legal due diligence, you can check if there are any pending court notices from the courts about unpaid, invoices from the suppliers or any other matter. So there are these are very important points which you need to make sure as part of the due diligence. Then the second part comes as a financial due diligence, which involves two major things: profit and loss and the balance sheet of the business. So it depends how big the business is. This process can be complex depending on the revenue and few other factors. So in profit and loss, what are the main thing is you need to make sure what are the revenue of the business, how much that business is earning, what are the cost, where the cost is going, and what is the profit of the. Of course, when you are negotiating a deal or when you sign a sales and purchase agreement, all this has been disclosed by the seller, that this is my profit, this is my revenue, these are my costs, and you have gone through the statements which was given. It can be audited statements or non-audited statements. So I suggest my clients to always have your own auditor when you are doing financial due diligence, especially if the business size is or considerably bigger, to make sure that you don't go wrong in that step. So this is a very important aspect where many people, they don't spend money on financial due diligence and they try to save that money, but that can be a problem later on when they discover that the business is not making that revenue which has been disclosed during the sales, and there is nothing or there is only so much they can do about it. Profit and loss, and then the balance sheet. In the balance sheet, you will know the assets of that business, what are the assets of that business, and what that business has, or we call it liabilities of that business. So that will show you that is it exactly or really what is it you bought has been disclosed during the part of the negotiation or the sales and purchase agreement, which is in by the time, I assume, if you're doing a due diligence, you already have a sales and purchase agreement in place with the seller at that point. And lastly, but not the least, is due diligence on staff. You can, speak to the staff, make sure that they're okay. There is nothing suspicious, or not that the staff, some of the staff, or maybe many of them are leaving if the ownership has changed, which can be a case in many cases that the staff has kind of a the bonding with the owner, and they want to kind of stick with the same owner. And if the owner change, they might leave the job. So you're better off speaking with the staff during the due diligence process and making sure that you're going to retain, if you're planning to retain the staff. I don't know. The situation can change, varies. Maybe you're willing to let go of the staff, but speaking to the staff is a good idea during the process of due diligence. So these are the steps you need to make sure when you're doing a due diligence before you're buying a business, you must do. Thank you. Thank you for watching Just Business Talk DXP, your ultimate guide to buy or sell a business. Press the bell icon to stay tuned with my new videos.